Hello, everyone. Welcome and thank you for being here this afternoon. My name is Tracy George. I'm the events coordinator here at Holistic Plan, and I am pleased to introduce Megan Dowd, our director of product insurance here at Holistic Plan. She has four specific designations, each related to specialized knowledge in different areas of insurance and wealth management. What we're talking about here today is really important, especially as it relates to Landlord Coverage 101, adding value for rental property owners, a webinar designed to help advisors better understand the unique needs of landlords. Whether your clients own a single rental property or a large portfolio, this session it will equip you with the knowledge to provide valuable and tailored advice. Before we dive in, yes, this webinar will be recorded. Yes, the slides will be sent out afterwards. And please direct any questions into the Q&A and we'll do our best to answer them as we go. I did wanted to mention this webinar is also eligible for one CFPC credit. So you do need to be here for live for the full session to get credit. So ensure you're here the whole time. And with that, I'd love to hand it over to you, Megan.
Thank you so much, Tracy. Welcome, everyone. Thank you so much for joining us this afternoon. Today, we're going to talk about landlord coverage and adding value to your rental property owner. So, we'll just do a quick introduction of the different policies, the different policy types, some insurance nuances that come along with landlords, things to consider when you're discussing risk management with your clients, and then just some important takeaways and tips. So, about me, I've been in the industry for about 15 years before I joined Plan. I did work with a decent amount of landlords, so I understand this exposure in depth. I also recently wrote a book called Protecting Your Lifestyle, which is available on Amazon. There is a little bit about landlord protection within that book. When I'm not doing educational things, I love spending time with my family and reading. So, just a little bit about me before we get started. The types of policy forms for rental properties. So, when it comes to the forms and rental properties, a few things. One, landlords are called, or landlord policies are called a few different things. So, one is obviously landlord. We then hear dwelling fire, we'll hear rental properties, we'll hear REI, but they all fall within the same insurance category, which is the simple term of landlord. But the policy types are a DP1, which is a named peril policy, a DP2, which is also a named peril policy, and a DP3. And what that really means for you is what and how things are covered within an insurance policy. So a DP1 is the most basic form of landlord protection out there. This is really the low cost option. And typically we see this on vacant homes or ones that have really old systems in their homes, whether that's electric, roof, HVAC. But ideally, your clients aren't going to have many policies that are a DP1 form unless, again, they kind of fall into this best use category. You'll also notice that with a DP1, there's no liability coverage. So if your clients have someone get injured on the property, they're not going to have any protection to pay for those damages and or support from an attorney or a defense team to help protect them during that situation. We also see loss of rents coverage, and we'll take a deeper dive into what that means for your clients. And then you'll notice this perils covered, and perils means type of loss. So the difference between a DP1 and a DP2 basically doubles the amount of covered losses your clients could experience. And then a DP3, which is the ideal type for a landlord portfolio, does have it on an open basis. Obviously, DP3 is going to be the most expensive, but this is where your clients can get replacement costs for their dwelling. They can get personal property coverage. There's usually liability included. So, really more of that package type coverage that your clients are used to versus a DP1 and a DP2 that sometimes take a little bit of navigating and piecing different policies together in order to get the appropriate protection. So when we talk about a DP1 policy, what you're seeing on the screen are the commonly covered perils. So that means, your typical wind or hail, lightning and fire, explosion. However, one that you do not see up here is water damage. And this is one of the most common losses to homes across the board, regardless if it's a rental or a homeowner's. And so this is a really big exposure that, again, typically goes unnoticed when clients are buying this policy until they have a pipe burst and they go to call their insurance professional, only to find out that all of that water damage is coming out of their own pocket. So not only is this, again, not the ideal policy, but it does limit coverage for one of the most common losses we see in the space. When it comes to the DP2 policy, there are typically around 16 excuse me, named perils. And again, this is where we get a little bit broader coverage. So we are going to have things like accidental discharge, damage by, aircrafts, freezing appliances. So this is where your clients, again, can protect their dwelling slightly better than on that DP1. And then all three policies have exclusions. These are your common exclusions when it comes to landlord policies. And this is where again, DP3 adds a lot of value because all losses are typically covered unless they fall within one of these exclusions. So again, that really puts the onus back on the insurance company if your client has a loss and they have a DP3 policy to say, hey, the loss occurred because of one of these 9 things. And if it didn't occur because of one of these 9 things, then your client's going to have coverage. So whereas we see on the named peril type policies, your clients are going to have to prove that damage was caused by one of these losses listed here versus, again, on a DP3, the insurance company is going to have to prove it's one of the exclusions. Next, we're going to talk through the different co-insurance. So you will probably hear the term co-insurance when you're talking to clients about their primary home, but co-insurance becomes a larger conversation in rental properties because this is where we tend to see clients more comfortable not insuring their homes 100% to value and taking on a little bit more of that risk in what we call a co-insurance, and really that shared cost. So what you'll see here in example one is a client insured the home to full replacement cost, which was $900,000 or close to. The true building value is $1 million, and they had an 80% co-insurance clause. So once they had a claim, they had $200,000 in repairs minus their deductible. Since they did meet the co-insurance clause, which is keeping this within 80%, so they had to at least have the home insured to $800,000, they're going to get the full claim payout of $199,000. However, for scenario 2, the client did not insure the building to value. They insured it on more of an actual cash value potentially, meaning that this 80% co-insurance was not met, which and led to a penalty at time of the claim payout. So you can see the math here. The cost to repair was about 200,000. They were underinsured by about 50% minus their deductible. They're only going to get $99,000. So again, this is very common to see where people fall below the co-insurance threshold and needing to or potentially having that exposure of additional out-of-pocket cost, where a lot of clients will think, oh, my out-of-pocket cost is just my $1,000 deductible. But again, it can become more. And for clients that have rental portfolios, a lot of times they tend to be in the same neighborhood or at least the same area. And if all of those are don't meet the clause and all have losses, this number can add up very quickly and really leave your client that once had a very successful rental business in a lot of uninsured claims that again could completely devastate that business. So coinsurance is something that you'll hear a lot about, but it really does become an important discussion if and when your clients have a claim. And a lot of times we see clients want to insure their landlord policies, potentially on like more of that market value, not true replacement costs. And if there's a co-insurance clause, and again, that market value doesn't align with replacement costs for some reason, we're going to see this scenario 2 occur more and more. Next, when we talk through rental properties, there is this market issue out there, which is that admitted versus non-admitted market. So again, this is something you'll see on a homeowners, but more prevalent in the landlord marketplace, especially once clients start to get, 10 or 15 doors underneath their portfolio. They tend to outgrow the personal insurance space and find themselves in the commercial market, which again has more of that flexibility in the non-admitted carrier. The big thing for you to know for your clients between the admitted and non-admitted space is admitted carriers are usually or have state support backing. So if that company becomes insolvent at time of a claim, the state will step in up to a specific dollar amount, which does vary by state, to help that client rebuild and obviously take on the duty that the insurance company can't do. With the excess and surplus, if an insurance company becomes insolvent, your clients are not going to get anything. There's no backing, there's no safety net in this marketplace. So, while again, it is a necessary marketplace for landlords and just where insurance is as an industry, there are some risk that actually go along with this that may not be prevalent within the standard market. So, again, something just to keep in mind. And when you see this admitted or not admitted, help your clients potentially understand a little bit about what that means for them. So next are some insurance nuances, and this is really where the details matter. And details matter that are often overlooked when your clients are having conversations with insurance professionals. And that's because they don't always have the same trust built that they do with you. So this is where advisors can really step in and, based on just the conversations you have with your clients every day, maybe highlight some of these nuances we're going to discuss. So when we talk about the details matter, we're going to talk through, the difference between commercial and residential coverage, replacement cost versus actual cash value, why titling can make a difference in all of this, how they use the location matters, and then obviously the tenants that are staying within that location. So first is just the difference between a landlord and homeowner's policy. While a lot of the terminology can be similar, the coverages and what's automatically included varies, just as we saw when we talked through the DP1, 2, and 3. But some of the bigger pieces that are not automatically included in landlord policies can be that personal property. So again, if your landlords take their units, dump them upside down, everything that falls out that the landlord owns is what we're considering personal property. So a lot of times that's just appliances. Maybe it's a stove, refrigerator. And again, if it's one unit, it's probably about $5,000. So not a huge issue. But if they have a four family and each of those units has, $5,000 worth of appliances, that's now 20,000 in personal property. And including that in the landlord protection might be a good decision for your client. So again, personal property is one of those spaces where on homeowners, we always recommend that clients rely on their home policy to help protect that. Whereas with landlords, depending on the amount of personal property they have within a unit, that is a piece that they could potentially self-insure depending on their liquidity. And again, that's where you as the advisor are in a great seat to know, like, hey, again, in that four family unit, if you did have to go spend $20,000 tomorrow, that would again completely disrupt your portfolio. Or hey, you've done the right planning, you've been in business long enough that you can write that check for 20,000. It's not going to make a huge impact, and we'd prefer to take that route versus paying an extra $400 or $500 a year to insurance to cover that property. So same with loss of use. In homeowners, loss of use helps for you as the primary resident to live elsewhere. But with landlord, it's loss of rent. So this is what's going to reimburse your landlords if their tenants can no longer live in a unit due to a covered loss, making it uninhabitable. So, if your client has a DP3 policy, they have a pipe burst, it does a bunch of damage, and the tenant cannot live there and has to go live elsewhere, they're obviously going to have to pay rent at that new location, but your landlord is still going to need potentially to recuperate those dollars to cover their overhead. So again, this is a piece that they can add to their landlord coverage to help reimburse them for those loss of rents. There are time periods and different percentages sometimes with loss of rent. So sometimes there's a 48-hour waiting period and they do it like 80% to the rent value. So that does vary, and something again to keep in mind based on how liquid a client's portfolio is, or again, maybe they have a lot of real estate capital, but not so much liquidity to cover rent if they couldn't collect it directly from a client, or sorry, from a tenant. And then we have this personal liability and premise liability. Personal liability, again, is what we see on a homeowners. It gives you protection off premise. So if you are at a bar and you get in a fight, a lot of your homeowners would, potentially pay out for damages that you caused in that situation, where premise liability on landlords is only covering that property. So if the loss does not occur on that property, the landlord policy is not going to respond. Usually that's okay for the landlord exposure, but it is just important to keep in mind that it is a little more limited than what your clients may be used to with their personal liability. And then medical payments, these are pretty much the same as the homeowners, but are really important to have on a landlord policy because these are no fault coverages. So if there's an injury that occurs on the premise due to the landlord's negligence in maintaining that property, they could quickly have, $5,000 available to that injured party without that injured party having to sue them and potentially get into this premise liability. So those are kind of the main differences we see between the landlord and, what we're used to seeing on a homeowner's policy. And then we have some commercial consideration. So the unique thing with landlord policy is every company has a different threshold from a personal lines perspective on when they no longer feel comfortable insuring a portfolio and where it has to go to that commercial side to do business. A lot of times this is determined by the number of doors or roofs and point number two. So again, some companies will only do 16 doors, meaning they can have four family units, and then they have to go to a commercial policy. Others will do it by roof, so they'll be fine with 16 roofs, even if that means there's 4 doors within each roof. And again, understanding the marketplace, what carriers look at doors versus roofs can really help your clients get a more competitive price based on, again, how that underwriting company looks at the rating perspective. The other considerations is when it comes to landlord policies, there's a few different ways that you can actually have a policy. So one is a reporting form. We tend to see reporting forms used when your portfolios have homes that leave. So whether that's your fix and flipper, maybe they keep some properties, but they are frequently updating the locations they have. Reporting form allows them to only be charged for the locations they have month to month. So again, not always great for those long-term rentals, but for more of your fix and flippers, it's a great way to only pay for what they need from a coverage perspective and not pay for coverage on a dwelling for 12 months that they may only retain for 6 months and then have to deal with refunds or minimum earned premiums and all of that jazz. So again, that's a lot typically for our fix and flippers of the world. We then have a scheduled form. This is really a nice piece once you have clients that have probably more than 10 doors or so. And this is because it's going to give them one single bill. They're going to have all the locations with, similar deductibles, similar coverages, and just makes the maintenance of the insurance policies a lot simpler. Um, we also have a blanket form. So this is where they might just have $10 million in property coverage and it's covering 20 different locations. And what that means is typically we see locations have specific replacement costs for each dwelling, where in a blanket limit, again, you would just have a bucket of $10 million. And if every home got wiped out, hopefully $10 million covers your portfolio. But the idea with the blanket form is, and hope is you may or most likely won't have a claim on the entire portfolio at one point to, again, kind of offset having to insure all of them to full replacement cost. So blanket form is a little more difficult to come by, but depending on the size of the portfolio can be a great way to protect the property. And then the individual policies. That's typically what we see on the personal line side, where each location or address has its own policy. And again, sometimes there can be 6 or 7 different policies for the client you're working with. It can be a lot to manage. They all have different renewal dates. Sometimes they're with different carriers, one's with Foremost, one's with Safeco. They have different, again, coverages within those perils. So, again, individual policies is what we see most frequently for the landlords that are just starting. And then as they transition, start to get more doors under their belt, they transition to one of those top 3 and tend to enter the commercial space. And like I mentioned earlier, where people start to outgrow those individual policies is triggered either by the number of doors or roofs that they have within that portfolio. And then we have business property. So it's similar to the personal property on a standalone landlord policy. But again, business property just may entail a few more things, such as if there is a rental office on premise, you might need to include computers and office furniture and different items than you would if you just have those individual rental units. And then lastly is the liability. So we already talked about premise liability, which again is going to provide protection for that entity of that address on that location, where general liability is going to provide additional coverages. Sometimes it can be for like marketing and advertising. There's obviously your personal, or sorry, just liability if people get injured, but it is slightly broader and again tends to be a better coverage option for clients that have more than just a few doors that they're kind of looking to protect. So next is the replacement cost versus actual cash value. And what you're seeing on the screen is a lot of math, but really the importance here is to help you understand the difference in what your client's going to receive and if investing more in a replacement cost policy makes sense. And again, that's going to vary per client, but this is just a good example to help get the math started. So a client has a $175,000 loss. They have a $2,000 deductible. Since they have an actual cash value policy, they have depreciation taken into account, which means if, again, all the appliances in the home are 20 years old, the flooring's 20 years old, all of that gets depreciated, and they come to an actual cash value, which is $81,000. Since they do not have replacement costs, which gives them that recoverable depreciation, the client's going to receive $81,000 at the end of this claim. Whereas with the replacement cost policy, which does cost clients more, I'd say this is just very simple math, anywhere from $500 to $1,500 a year. So not cheap, but if they have a loss, they're again, same deductible. They still will have that depreciation. A lot of insurance companies pay actual cash value up front first. And then as work gets done, they start to pay out that depreciation value. So again, this is one where your client would basically be made whole again after that deductible. So they'd get about $173,000. The thing with landlords, and we'll talk about this in a little bit as well, is choosing between actual cash value and replacement costs is sometimes as simple as is how handy is the owner? Are they someone that's going to have to pay to have someone come in and fix things? Or again, can they do the work themselves to where they can, again, take on a little more risk and the actual cash value is not as bad for them? But again, your client that is just the one writing checks, doesn't know how to pick up a hammer, would really need to lean on the insurance in order to replace a home, spending a little more on the insurance policy year over year to get this full coverage might make sense for them. And again, that can even vary from house to house. When I worked with clients, I'd have some clients that had the older homes covered on an actual cash value or a functional replacement cost, where they had their newer homes in their portfolio covered on replacement costs. So that's the benefit of an individual policy is you can determine how you want to cover the dwellings and other structures based on that specific location versus having to make a choice for an entire policy form. And then we have titling. So when we talk about titling, first off, I'm not an attorney, so this is just educational purposes only. We see rental properties titled in a few different ways. So sometimes that's a sole proprietorship, partnership, C corp, S corp, limited liability company. When I was in the field, I typically saw the limited liability company, which obviously shields them from personal liability, but there still is potentially some exposure there. And again, no real preference on how clients title it, but however they decide to title it, it's important that the name on the deed matches the named insured. It was mind blowing how many times a client would again buy a property in the name of an LLC, but then when they called to buy the insurance, they'd want to buy it under Mr. Smith. And it just like never clicked for them that they needed to buy it in the name of that LLC. So when it comes to titling and insurance specifically, the main thing that matters is that the named insured has insurable interest in the location, and typically that's driven by them having ownership in the deed and those sorts of things. So again, since the limited liability corporation or company was the most common one, and honestly it's the most common one I've seen claims arise for that also dip into personal assets, is clients love to set up LLCs, especially for rentals, but they don't understand really what that means. And so, what ends up happening is they, again, set up the LLC for that home. They then call the insurance company and they pay for the annual insurance with their personal credit card. And now, since they're using personal funds for the business, that could be seen as piercing the corporate veil. And if there's a loss at this location, the client's LLC really holds no, or no value because now a court could potentially come after both that LLC and the individual since they've used, again, those personal funds in the operation of the business. So, um, again, I think this is more on the attorney side to remind clients, but since you all are talking to your clients all the time, sometimes you do help them pay bills depending on how much handholding you do. This is a piece that even you should potentially be aware of and understanding how we're making payments to cover insurance, how we're paying the landscape company that does the work, how we're paying the HVAC company that comes over to do a repair. Again, how money moves through landlord policies. Does matter when a claim arises and really making sure that titling and entity protection comes into play. Next, we have usage. So when we think through usage, there's a lot of different ways today that clients use their homes that wasn't that way 20 years ago. So what I will say is, one, insurance companies are still catching up to this shared economy that we see today, and not all of them love it. So when it comes to landlord policies, it is very important that your clients are disclosing how they're using their location. So obviously, month to month is going to just be that month to month. A lot of times we see this from more of a professional setting. Maybe there's doctors in the area, those sorts of things. This is typically looked at the same as a short term rental, meaning they'll need that like shared home endorsement on their homeowner's policy and or a landlord policy. So the unique piece to like a short term or month to month is sometimes your clients can insure them on a standard homeowner's policy and then add a endorsement for, again, that shared economy. Where I see that is when clients have a second home that maybe they rent out 80% of the time and then they use it for their own personal use 20% of the time. Insurance companies, again, depending on who they are comfortable, since there's some personal usage at that residence, to insure it on a homeowner's form, which is giving your clients broader coverage than if they go that dwelling fire route. If your clients only use this to rent out to generate income, typically it's going to go on a landlord policy and not on a standard homeowner's policy with an endorsement. Um, Fixed long-term and mid-term rentals, again, work similar in that those are always going to be on a landlord policy of some sort. These are obviously year-long contracts and or sometimes, 6 to 8 month contracts. These are, again, a lot of times professionals and or where we see portfolios start to really build. So clients may have a few short-term, but then like 10 or 15 long-term rentals. And on an individual policy, that's okay. But as we go to those blanket and reporting forms, it is important to disclose the different usages between the locations, as they may have different rates on that reporting form based on how those are used. The rent to own, this is an interesting one to really think through because technically the ownership hasn't totally transferred at this point. So a lot of times it's recommended that you have a policy, a landlord policy, and that the tenant who's doing the rent to own still has a renter's policy. And then obviously, once the funds have fully been transferred to you and the document has been signed and you have sold them the home, that's when the tenant goes and gets their own homeowner's policy. And obviously, you no longer have insurable interest as from a financial standpoint. So your client would not need to do anything. I have seen though where clients want the individual who's buying the home to carry the homeowner's insurance and add the financer as an additional interest or additional insured. That's okay. The important piece is though that your clients who own the location are still extending liability to that location in case there's injuries that arise and they're named in a lawsuit. The liability, we still want, to protect them there. And again, being an additional insured on the home policy that is owned by the tenants at that time would also give your clients that coverage from a dwelling perspective. So if there is a loss, the check from the tenant's insurance company would be made out to the tenant and the your client, which is the additional named insured in that case, and that's how they can protect their financial interest as well. So a little more complicated, but again, depending on that situation, can kind of vary on what your clients decide they want to do. And then the fix and flips of the world. So this is where I see landlords tend to go a lot cheaper on the insurance, which is totally okay. They tend to go those DP1 policies a lot of times because they're vacant during the fix and flip situation. If tenants are living in the home while renovations are being completed, please disclose the renovations to the insurance professional, as there may need to be an endorsement for like a builder's risk policy. The other thing I've seen is where landlords will let a tenant stay in the home and fix it up for free rent, which sounds great in theory. However, if that individual is injured while fixing that home, there could become some liability issues there. So, again, just clearly understanding if the individual that's living in the home has workers' comp insurance, if they have general liability insurance, if they damage the home while they're fixing it for that client. So, an example would be, maybe they go to install a new toilet and they don't install it properly and they leave for a few hours and now that toilet's completely flooded the unit. Does the landlord really have the ability to go after that tenant for the damage? Is it going to fall on theirs? There's a lot of gray area that comes up. So again, if you hear your clients are allowing people to stay in their homes rent free so they can do work, just really understand the liabilities that come along with that, and where, if and when damage occurs, who is responsible for that damage. So next is our tenants. And obviously, who stays in the home matters. Renters insurance is something that every one of your clients should require their tenants to carry. I've even had landlords that just start to purchase coverage for their tenants. They include it as part of the rent. So they add an extra $15 a month to their rent. They have a policy purchased in the name of their tenant. They just cover paying for the cost. That way, if there is a loss, their tenant has coverage for their personal property. Sometimes there's loss of use to help pay for them to live elsewhere. If in that meantime, while they can't live in the home, the cost to stay somewhere else is more than what they can potentially afford due to this short notice. There's also liability. So again, if maybe the tenant has people to their home and injuries arise due to the tenant's negligence, their renter's liability can help pick that up versus it going directly to the landlord's liability. So there is some benefit in landlords helping their renters obtain and keep renters insurance, not only for the renters protection, but it also does in some situations add a layer of protection between the landlord and what's happening on that property. Next are animals. So again, some landlords will tell their tenants absolutely no animals are allowed. Other landlords allow animals to be on premise. And that matters because there's a lot of exclusions for animals on landlord policies. While it's sometimes on a homeowner's policy, I would say it's more typical to see that exclusion, meaning your clients have no coverage if an animal bites someone on premise. Again, that's where that layer of renter's liability can come into play, because hopefully that dog is the tenant's, and in that situation their coverage would apply. But maybe they had the dog in the backyard and the fence wasn't installed properly or wasn't being maintained and the dog got out and bit someone. Your client, as the landlord, could be held responsible for lack of maintenance to that fence. And again, if their landlord policy has an animal liability exclusion, they are going to be out of pocket for those damages. So that their requirement is to maintain the property. And so as long as they're maintaining the property, that should, hopefully eliminate some of these issues. The other issue with animals is that can be breed specific. So if your landlord doesn't say, hey, we only allow small dogs or non-aggressive breed dogs, while there may be liability for dogs in the policy, there could be specific exclusions for a specific breed type. So again, just understanding who's in the home can make a big difference, even when it's not just the humans. Um, Next is background checks. So this just one allows your landlords to know who's coming in their home, if they have prior, issues from damaging things, and there are discounts available when background checks are done. So this is just, again, a nice way to help your landlords be a little more in the loop with the people that they're inviting onto their premise. Next is subleasing. So a lot of times this is in a lease with tenants that if they decide to sublease, they need to let the landlord know and like if that's even like acceptable or not. But that does affect insurance. And so again, depending on the unit and where and how the subleasing is occurring, it's important to disclose that to your, or have your clients disclose that to their insurance professional. Next is student housing. So this is one where I see a lot of individuals don't intend to get into renting to students, but maybe they have a kid go away to college. Instead of just paying for them to rent somewhere, they decide to buy a house on campus. And once their child leaves, they just continue to rent it out. When they're renting it to their child, it's okay just to be on a landlord policy, not so many red flags. However, once there's no family members living there and it's truly like a student housing um, unit, there can be limitations and it can limit the options in the marketplace. And that's just because, unfortunately, student housing has a higher risk of liability losses and claims and situations like that. So, student housing is something that isn't frequent, but I do tend to see that. Becoming an issue just through natural transition of, again, that college kid. Now they just decide to keep the home, they rent it out. Maybe they do short-term rentals, whatever that is. As that usage changes from uh, residents staying there to, again, unknown residents, this is a great place to add in a little bit of education and just tell your clients to discuss that change in exposure with their insurance professional. And then lastly is businesses. It is very common today for tenants to run businesses out of their locations, whether that's they're doing accounting, they're doing landscaping, they're doing whatever. The big issue here is if people come onto premise. So obviously, if it's a landscape company and they just take their equipment off premise, not as big of an issue. Obviously, their equipment needs protection, but from a liability perspective, but where there can be an issue is maybe your tenant is an accountant and they do have folks coming into that home. That is where we see a lot of exclusions and or limitations for coverage. And again, just making sure your clients know somewhat what their tenants are doing on property will help them either better prepare if a claim arises or maybe educate that tenant on, hey, love that you're, aspirational, you're running a landscape business, but just remember my all of your equipment in the garage has no coverage. So if there is a fire tomorrow, your business would have no protection and, edging them along to go get their own coverage for that business. But again, other people's choices when it comes to landlord coverage can land your landlords and mostly a liability issue. And so just being clear on these things with their tenants can help them avoid those issues in the future. So, what are some things to consider? First is, like you've heard me say, tenants should really carry their own liability. Even if you're offering like that midterm or short term rental, having them check with their homeowners to understand if coverage extends to them while they rent your location is something that your landlord should be doing, again, just to have a better understanding of where their coverage may intentionally have to pick up or where the individuals staying in the home have their own coverage and protection. Engage a management company. So this is something, one, that adds discounts to your client's policies, but two, there's a lot that can come when you're a landlord. So whether that's, rent not coming in on time, maybe you have to evict someone, maybe you have to decline somebody's application, all of that can potentially lead to lawsuits, whether that's discrimination on an application, wrongful eviction, and a management company can just help eliminate those issues. And a lot of times, management companies will have insurance if those issues do arise that protect them and your client in those situations. So, as clients grow their portfolio, a management company, in my opinion, is really a must have to, again, put that layer of protection between them and the tenants and decisions that naturally occur as a landlord. Next is loss prevention. So again, a lot of times we think about loss prevention for our primary homes, but don't always think about it for our rental properties. But there's a lot of discounts that can be added and just a lot of claims that can be avoided, whether that's, alarms, security cameras, water shutoff valves. So unfortunately, it's not uncommon for tenants not to want to call landlords to come into the home, and they may wait for water issues to become super bad, like the dripping underneath the bathroom sink. They wait until like the water's coming out or maybe there's mold growing, and a water excuse me, a water shutoff valve can potentially help avoid those situations. So you can put sensors underneath all the bathrooms underneath the refrigerator in case the ice machine starts to leak. And that way, the landlord can be notified if there's water dripping on one of those sensors. And if it continues, the sensors can actually shut the water off to the home to avoid future damage. So, again, this is a great way to not be too intrusive, but still protect the home and be proactive when these larger issues start to arise. Especially remember, DP1 policies exclude water damage. So, for your clients that have these vacant homes, maybe a water shutoff valve or just a water detection system that you can get off Amazon could help protect them. So if those vacant units do start to have water issues, they can be notified, get over there quicker versus potentially waiting a week or two until they do their next scheduled stop in and then they find the damage and then it's really bad. So these loss preventions are great ways to mitigate loss, whether it's an occupied unit and or a vacant unit. And then lastly, align coverages. So really help clients understand maybe where their personal coverage and where their rental program coverage align or don't align. And again, we'll talk through this in the next slides. A lot of this though comes with their umbrella policy and when excess liability extends over the rental or when a commercial policy may be needed. So what are some important tips and takeaways? Some home heuristics that you can help your clients pay attention to. If your clients say, "Hey, I found this property, it's a steal," it probably means it's a red flag and there needs to be some insurance homework done before they go and make that final offer. And I say that because just because it's affordable to buy does not mean it's affordable to insure. And a lot of times in that situation where the home's affordable, the insurance makes it a very bad business decision because insurance can be $8,000 a year in some of those situations. An example is we have a lot of I live in St. Louis, and we have a lot of older brick homes down in the city. They're 2,000 square feet, 4 layers of solid brick, and you can buy one for like $10,000 in some situations, $80,000 in other situations, but the cost to insure them is $6,000 a year because the cost to rebuild a 2,000 square foot solid brick home is over $1 million. And so that's where, when landlords, especially when they're getting started, look at that profit margin that they may or may not have, that expected, hey, I'm spending $80,000 on this location, so the insurance should be $1,000 a year. That's just not how the math works. So again, doing research on those affordable properties before they purchase them is an important piece of landlord ownership, especially when clients are getting started. This is where I see them again find a home that looks like a great deal. They've never dealt with insurance on landlords and then they go to buy coverage before the deal closes, especially if it's a cash deal, only to find out that like the insurance completely makes those numbers not work anymore. Um, Next is older homes. So older homes that have not been updated in 30 years are very hard to insure. So again, whether that's due to knob and tube wiring, the roof age being old, which that next one hits on roof age. There's a lot that goes into older homes. And if the systems are over 30 years old, they most likely won't qualify for anything besides a DP1, maybe a DP2 policy, but that does limit the ability to get that broader coverage on a DP3, which clients may want for their program. And then lastly, again, the roof of the age matters. This is something we're seeing across all types of homes, whether it's a landlord or homeowners. But if the roof is over 15 years old, a lot of times we're seeing that not be insurable and or there being actual cash value endorsements put on, which is okay. It's just important for your landlord to know that most likely if there's hail damage that happens or anything that happens to the roof specifically, they're going to be paying out of pocket for that because the insurance company has limited, if not excluded, any damage for the roof. So, just a few things that, again, as you listen in to clients who are in this space, that might, again, be a great way to add quick value. So next is consideration at time of claim. One is landlord policies. The loss history can get complicated. And again, this varies by carrier. So some carriers will look at the entity and the claims that have happened on that entity. Some will look at it from a location specific pricing. And other times they look at both. They look at both the location and the history of that entity. So this is where having landlord policies in your personal personal name can become a really big issue, because if you have a few losses on your rental portfolio, your primary home may become uninsurable due to your overall loss history as an individual. So not only from like a legal purposes, LLCs and some other entities better, but even from how claims in a rental world can affect your personal life and your personal protection that's available to you is something to think through as clients build out those rental programs. Even if a home sold, it can still sometimes come into underwriting eligibility. They may not see a surcharge for it, so they're not going to see an increase in cost, but it is going to potentially determine if they can do business with the company or not, based on, again, damages that have occurred at homes they've sold. And the damage would obviously have occurred during that ownership, but even them selling it doesn't always release them from that claims history. And this is where deductibles really matter, because with the right deductibles, your clients will be filing claims that are financially necessary. They won't be filing the claims because this is why I have insurance, I have a low deductible, I have never filed the claim, so let me just get this claim filed and move on. With the right deductible and the right education, your clients are going to use insurance in the way it was intended, which is for that catastrophic situation that they cannot self insure. And again, this is a conversation, deductible specifically, that insurance professionals don't have the luxury of always having with clients, because clients keep their money close to their chest. And that's where you all have built a tremendous trust with them. You do know how much money they have liquid. You do know that they can most likely the difference in their financial situation if they have a $5,000 deductible or a $20,000 deductible and actually have to write a check for that. From an insurance perspective, I could just say, hey, this is what it saves you. But from your perspective, you can say, like, well, yes, it only saves you $300 a year to go from a 5,000 to 20,000. If it doesn't affect your bottom line if you write a check for either. So let's save that $300 a year, again, knowing that you can comfortably write a $20,000 check. Where another client may say, hey, you have very little liquid. You need to spend $300 more a year to have that $5,000 deductible. It's not worth it to go to that 20,000 and put yourself in an uncomfortable financial situation. And again, this is a conversation that as advisors, I feel you're in a unique position to have, because you do know their liquidity a little better than an insurance professional. Um, and then another thing to think through when you're talking about deductibles with clients is your landlord handy? Can they fix it themselves? Again, if they can fix it themselves, or they have a crew that they already pay kind of on salary to do these sorts of things for them, carrying a higher deductible is probably okay, because they already have maintenance or repairs as part of their line items in the overall business plan, which means they can take on a little more of that deductible. If this is your landlord that, again, just does it as like a side hobby, or it's their first home that they never sold, but they couldn't put a new door handle on if someone paid them, maybe having a lower deductible could make more sense to them. And or again, just educating them on, hey, we're going to keep a high deductible, and any claim under this, you're going to find a local handyman that's insured to come and fix it, but we're really going to use insurance once it hits this dollar amount. So again, sometimes depending on how handy clients are can also be another determination in how high of a deductible they could be comfortable taking. And then lastly, your surcharges. So just like homeowners policies, landlord policies do see a surcharge for 3 to 5 years after a claim occurs. So again, maybe the first claim not that bad, but the second claim could become very impactful. And if you have a claim on 3 different homes year after year, you really could have surcharges for a long period of time. So again, really helping clients understand that they should be only filing landlord claims when financially necessary can allow them to pay the correct premium year over year versus having to potentially spread out surcharges due to covered losses. And again, those surcharges don't feel as bad when your client's got a $50,000 or $60,000 check from the insurance company to put on a new roof. But those 3 to 5 year surcharges do really hurt when they got a $2,500 check because the water backed up and they wanted ServPro to come and clean out the basement versus themselves or somebody else, or just covering that 2,500 out of pocket. So that's the other piece to surcharges is those smaller claims, you just really feel that impact, where the larger claims, it feels a little more useful to see that increase year over year, knowing kind of the financial support that was had at that claim. And then lastly, this is one that I honestly had a hard time putting together in the best way to describe it. But when it comes to umbrellas and landlord policies, it gets a complicated, like a lot of things. But these are kind of the different equations that I came up with to help better understand, like, when can my clients use a personal umbrella and when can they use or expect to have like commercial umbrella. So personal umbrellas will extend over a landlord policy that's on a personal lines form. Usually that's clearly stated on the policy. It has to be in the name of an individual. And if the name of the individual on that landlord policy matches the name of the individual on the personal umbrella, coverage is going to extend. Same thing if the landlord policy, again, personalized form, maybe it's owned though by an LLC. It has to be a single, or usually has to be a single member LLC plus no other business in that LLC, then it can still be covered by a personal umbrella. Where we see it go to a commercial umbrella is when the landlord policy is in a business policy form. And it, again, is usually clearly stated like business or commercial on the declaration page. And it's in the name of an individual. The trigger here is it's on a business policy form. In 98% of the time, a personal umbrella does not extend over a business policy form. There is a few umbrellas out there that do that. So there's always a situation with insurance where it depends. But for typically, rule of thumb, if it's on a business form, is when it kind of triggers that commercial umbrella need. The other piece would be if it's obviously on that business form and it's in the name of an LLC with multiple members or mixed revenue generated, or another one would be like mixed use. And where we see this become an issue is when your clients purchase that mixed use building where the top half has a rental above it and the bottom half is used as a storefront. That is not where personal lines is comfortable. And a lot of times that's where the commercial, not only policy form comes into play, but also umbrella. So mixed use buildings tend to drive the business to the commercial side, where if it's just individual residential properties, it tends to lean more on the personal line side until you really build up that portfolio. So I know we only have about 9 minutes left. So any questions that I can answer?
Yes, we actually have a couple already. So the first one is, are there 16 or 18 named perils on DP-2?
Yeah, so it can vary. Some insurance companies give 18, some may give 16. So that's definitely going to vary based on the carrier specifically.
Perfect. The next question is, what are your thoughts on putting rentals into LLCs via getting large liability policy?
Again, I think how they use the LLC is important, and as long as they follow those rules, liability is the cheapest thing your clients can buy. So I know attorneys aren't always the cheapest to work with, so it one might be good just to get pricing on both, but typically $1 million umbrella policy is less than $200 a year. And so I personally feel like it's probably a good investment to have that umbrella, but that is kind of the purpose of an LLC. So that's, a little bit more of a gray answer, but it would unfortunately depend.
Alrighty. The next one is, what's the best way to determine if the insurance provider is admitted or non-admitted?
Yeah, so a lot of times it states on the declaration page if it's admitted or non-admitted. You also may see like some taxes or inspection fees tend to be on the non-admitted markets. And technically, the insurance professional that places the non-admitted business would have to disclose that to your client, and they sign a document agreeing to have business placed in a non-admitted market. But usually, it's listed on the declaration page.
Like, we have another question, almost similar. It says, can you explain more about admitted vs non-admitted? Like, why would you use a non-admitted insurer?
Yeah, so a lot of times clients go to non-admitted insurers, one from a market availability. So if it's in certain areas like California, Florida, it's similar to the homeowners world, they can't get coverage in the admitted space, so they go to the
Mhm.
non-admitted. Sometimes non-admitted can be a little more customizable. So a lot of times those policies, they can add additional coverages or remove or like add exclusions. So if there's a building that your client owns that has a lot of water losses, a non-admitted market might be able to give them at least some property coverage, but exclude water. Where like an admitted market, they can't really change their policy. Water losses just might completely exclude it from eligibility and they can't get creative with it. Where again, that non-admitted market allows them to get creative with the coverages and still offer some type of protection. So a majority of the time we see non-admitted markets come into play when the standard markets won't write it. And again, other times it's because of loss histories or location. Very rarely is it cheaper, but that is in some instances where clients will go with it. But it's usually cheaper because the coverages aren't as comprehensive as what you see in that admitted space.
Right. The next one is, can you get both types of policies if you rent part of your home? What is the best way to handle a client's house when they rent part of it or an ADU?
Yeah, so that's where the homeowner's policy with an endorsement usually makes sense. If it's the like garage or another structure that's being rented out, typically that endorsement will still work. So I would say majority of the time, endorsement on a standard home policy is the way to go. But there are carriers, depending on the frequency of that, that might require, especially if it's in the detached structure, a separate policy. Um, Usually, if it's part of the main structure, it's either they will allow an endorsement or they won't write the business. So if the client's currently with the
Right.
company and they say, "Hey, I've now added this," they might become ineligible for that company and or that company might have the ability to add endorsement.
Mm. Next one is from Kevin. It says, what are the pros and cons of a landlord putting their rental into a revocable living trust? Thank you.
So I'm not an attorney, so I'm probably not going to
Mm.
answer that completely. But I can follow up once I consult with a few just to give you a better, clear answer. But I don't totally know from a liability perspective what that, revocable trust does or doesn't do, but I'm happy to
Mm.
look into that or
Alrighty.
irrevocable.
The next one is, any tips or things to consider for those who may be house hacking, living in the home, but then maybe renting out additional rooms to roommates?
Yeah, so their roommates should definitely have renter's insurance because the owner of the homes, again, policy is only going to cover their contents and their liability. So any of those individuals that are in a shared room are going to want their own coverages. And they should also disclose that to their insurance professional because they may not be comfortable with room sharing. A lot of times, there is actually language in the insurance policy that limits the amount of roommates you can have or um why am I like non-family members living in the home. So that is something that needs to be disclosed.
Oh, and then I have two that are similar. They're about book recommendations. One is to educate themselves as a new landlord, and another is good resources to reference when needing a quick answer to the topics you covered today, slash books to read.
So I don't have any great books to read about landlords. I do work with a lot of landlords, or I did. So I'm happy to reach out to them to see if they have any recommendations. But the exciting piece is Holistic Plan will be doing landlord reviews as of July 2025. So you all will be able to upload your landlord policies to us and get the awesome insights that you're used to seeing on the home and auto and umbrella now through landlord. So I would say we will be a great resource going forward to get some of this content. But at this point, those are kind of what I'm aware of.
Alrighty. So the next one is there any way to find out what the potential surcharge will be in advance? Is it a percentage?
Unfortunately, no. It varies. For very simple math back in the day, and I don't know, I heard this one time, it was probably 10 years ago now, but the first claim can be anywhere from like 8 to 15% on average. So obviously higher or lower. But the second claim is where, that number becomes really hard. And the thing with insurance is rates hit different pieces of the coverage differently. And what I mean by
Mhm.
that is, while just for easy explanation purposes, while there may be a 15% surcharge, that surcharge may only be on the dwelling premium, not on the endorsement premium, where other times that surcharge could be on the total premium. So doing the math like on the back of a paper napkin, I would not totally recommend, and or just know that it is math on the back of a paper napkin and is just
Mhm.
from simplicity purposes. But unfortunately, today there's no real math out there to help determine.
Alrighty, we do one more question. This question is how to measure and cover climate change risks.
Yeah, so, that's I think a larger conversation. We are diving into that here at Plan and should have some exciting news before the end of the year on how we can support it. But it's in the news today. So, while I hate to say go to Google, today that's kind of the best place from an environmental perspective and being up to date on like what's happening. But that is on our radar here and hopefully something we can share with you all soon.
Alrighty, perfect. If we didn't get to your question today, I'll be sure to send it over to Megan so she can answer in the follow-up email. We are nearly at time, so I just want to say thank you so much, Megan. That was amazing. And just to recap, as I saw in a couple comments, that we will send out the slides and the recording, so sure to keep an eye out for that. And I just want to say thank you so much, everyone, for attending. And with that, we'll see you next time.
Have a great day. Thank you,
All right,
everyone.
bye.